Hello, my name is Jon Henry, and I'm from Baillie Gifford and a specialist on the Monks Investment Trust. I'm here to tell you a bit about the trust, why it's an attractive long-term investment for savers, and the power of compounding. So, first of all, what is Monks? What's the bare bones of the trust itself? Well, Monks is a global investment trust seeking to invest in growth companies from anywhere around the world. We focus on capital growth over the long term. So it's an ideal saving for pensions and for long-term saving pots. We seek to deliver long-term capital growth in excess of global equity markets, in Monks' case, the FTSE World Index. And importantly, the trust is low cost, so around 44 basis points in ongoing charges. So what's the underlying philosophy of the trust and its approach? Well, firstly, a key facet of what we do is the belief that it's sustainable compound growth that drives long-term wealth creation. So that is the ability of companies to deliver profit and earnings growth over long periods being the key driver of share prices. So we seek to identify companies with the potential to deliver superior levels of earnings growth over long periods. The second point is focus. So we believe in being selective about the companies that we own within the Monks portfolio. It's really few that manage to meet the standards that we look for. So the portfolio is made up of around 100 holdings and what we believe to be the very best growth companies from right around the world. And then finally, we believe the important task on our part is to be patient, identify those companies and own them for the long term. So we seek to own those businesses and allow them to deliver the growth that we're seeking. And importantly, we make sure that we hold those companies accountable over long periods and engage with those businesses as we seek for them to deliver the most value for our investors in the Monks Investment Trust. Our baseline hurdle rate for growth is that we're looking for all of our holdings to have at least a 30% chance of doubling in share price terms over rolling 5-year periods. So I touched a little on the importance there of compounding. What I've shown here on the next slide is really two things. Along the top there, you have a holding period, so number of years that you would invest in a company or an investment. And on the left-hand side, the annualized growth rate. And what it then shows you is the compound effect of owning those stocks at those growth rates on the left-hand side in terms of the outcome for investors. So the multiple times your investment that you can make. So for example, if you invest in a company that's growing at 20% for 2 years, you'll achieve a multiple of 1.4 times your initial investment. Now, the important and interesting thing about this is that the grey area highlighted between 1 and 2 years is the typical holding period for most investors in the market. Now, the returns at 30% growth are okay, but what I think is most interesting is if you apply the discipline of patience and you start to cast your eye to the right in the blue shaded area, you begin to see, particularly further out, that there are much greater returns to be had for investors over longer time periods. So if we can find a company, for example, that is growing at 20% and we can hold that business for 8 or 9 years, we stand to make somewhere around 5 times investors' money within the trust. And that's really what we're seeking to do with the Monks Investment Trust, and the belief that if you can identify the right businesses and own them for long periods, that's how you're going to deliver the best outcomes for savers over the long run. Now, one of the key facets of our approach is to look broadly for growth. So we have 3 types of growth that we try to embrace within the trust. We have growth stalwarts, we have rapid growth businesses, and cyclical growth businesses. So let's touch on those one at a time. The first on the left-hand side is growth stalwarts. These are your steady Eddie businesses. These are companies that are usually very established with a pretty sticky customer base and are able to deliver the levels of earnings growth that we're looking for, in this case, are around about 10% per annum over very long periods of time. And that means that they tend to be more resilient in different macroeconomic environments. The example we have here is analog devices, which is an analog semiconductor business. Analog semiconductors are key in pretty much everything we use these days, mobile phones, laptops, and as the proliferation of those types of electrical devices continues, analog is one of the key players and market leaders in that sector. The second is rapid growth businesses. Now, these are companies quite different to stalwarts. These tend to grow their top line much more quickly. So they're earlier stage, disrupting businesses and markets more readily, often growing their revenues in excess of 20%. And sometimes earnings and profitability can be a little further down the line, but they're hugely exciting and have the potential to be really exceptionally high return investments. An example here would be Mercado Libre, which is the Latin American e-commerce and payments business. And Mercado Libre is doing a fantastic job of building out e-commerce infrastructure in Latin America and markets like Brazil, Argentina, and Mexico. And importantly, it's creating a really exciting ecosystem of not only e-commerce and delivery, but importantly, payments and lending. So it's bringing together merchants and buyers on the same platform, which we think is a hugely exciting and potentially very valuable franchise in Latin America. So one of our most exciting holdings is a rapid growth holding in Mercado Libre. And then finally, on the right-hand side, we have cyclical growth businesses. Now, these are businesses where we're looking for management teams to allocate capital in a counter-cyclical way at the right point in the cycle. So rather than at the top of the cycle, they're investing at the bottom and enjoying that growth period as the cycle returns or as the economy recovers. And in this case, we've used CRH, which is a building and materials business, which is an Irish business, but a majority of its operations now are in the US, where it's managing to build a really strong business based on very strong pricing power. So the ability to raise prices year on year is something that CRH has consistently been able to do over very long periods of time. And as a result, it's been one of the really very best performers for the portfolio over the last few years. So hopefully what you can get a sense of here is that in looking after Monks, we're able to take a very broad approach to growth, a wide-angled view of growth, by embracing these different growth types and building a portfolio of really eclectic and exciting companies that can drive returns on a very long-term view. I thought it's worth highlighting some of the key characteristics that we look for within the Monks portfolio, and I think we can put these into two broad areas. One is that we're looking for really solid foundations for the companies that we own, and that is really resilient, strong balance sheets. So net debt to equity, the level of borrowing companies need to function and operate, is much lower than the broader market. So roughly 10% net debt to equity compared to around 50% in the broader index. So much less reliant on debt funding than the broader market. And that's really important when interest rates have risen sharply and we find ourselves in the environment that we do today. Also, the companies themselves are generally very free cash flow generative. So they can generate cash flow, which they're then able to invest themselves. So linked to the need not to borrow significant sums of money, they are instead generating their own cash to invest and grow. And that's critical. So they have these two foundational building blocks that we think are essential in today's world. And importantly, in tomorrow's world, we're looking for these companies to invest that in the businesses to secure future growth. So we can see the third bar chart from the left shows the research and development spending relative to sales. And that's much higher for the holdings in the Monks portfolio than it is when you compare it to the wider market, which suggests that these companies are investing for future growth more meaningfully than the average business. And then finally, what does that culminate in? Well, it culminates in a better growth outlook. So when we look at the forecast earnings of the portfolio, we can see that on average, the portfolio is forecast over the next 3 years to deliver 14% earnings growth compared to just 9 in the index. So again, we own a company, a holding or a group of portfolio holdings here that have significantly more attractive earnings outlook than the broader market, which, as I said at the start, is a foundational principle of what we think drives long-term capital growth. So what does the portfolio look like? Well, I mentioned that we own around 100 stocks in the portfolio. Most of those are listed equities. We have a small proportion of the fund which is invested in unlisted opportunities, around about 3.5%. But most of it's in listed equities. And when we look at the underlying structural drivers of growth, what we see is we have a portfolio that's built or aligned with several really strong structural changes in society and economies. What I've tried to show here on the slide is some of those key themes. On the right-hand side, you can see what we've entitled Digital Frontiers, which is a rather broad title, but encapsulates a range of different subsectors, if you like, or meaningful technological changes which are happening today, where we have investments that are either driving that change or indeed benefiting from it. So, for example, in enterprise cloud computing, and more of our infrastructure and technology is moving from on-premise software and hardware to being on the cloud. Businesses like Amazon Web Services, Microsoft Azure are owned within the portfolio. Chips everywhere. On the right-hand side, there is reference to the growing exposure the portfolio has to semiconductor businesses, and many of which are absolutely fundamental to the growth of artificial intelligence and the impact that will then have on businesses and services in the future. So we own NVIDIA, the semiconductor and graphics processing units business, which has a 90% market share. But importantly, we also own a range of other businesses in the value chain, such as Integris, which makes cleaning and filtration equipment essential in the manufacture of semiconductors more broadly. And then finally, at the bottom of Digital Frontiers, we have digital payments. I'm sure all of you use elements of digital payment technology in your day-to-day lives. Well, in different parts of the world, digital payments are at different levels of penetration, and we have exposure to a range of those companies within the portfolio. I mentioned earlier Mercado Libre with its payments business in Latin America, but we also have investments in Block, which owns the Cash App and Square payment terminals in the US. And we also own Adyen, which is another payments facilitator for large enterprises looking to do business globally. So these types of technologies are increasing in their proliferation, and Monks has really positive exposure to a lot of exciting names in that part of the economy. I think we can contrast these very technologically led investments that we have in the portfolio with a number of what we're calling repair, renew, revitalize, or infrastructure-led type investments. So, for example, we have a number of names in the portfolio that are geared into domestic infrastructure spending in the US, which is increasing as we look forward. So I mentioned CRH, but we also have Martin Marietta and Materials and Building Supply. We have Advanced Drainage Systems, who are the leader in composite plastic storm drains, which are taking market share from concrete equivalents. We also have Eaton in electrical componentry, or Stella Jones in telegraph poles, which are essential in the upgrade and build out of the telephony and digital network in the US. So we're really able in Monks to build a portfolio with really high-tech, leading-edge technology alongside real-world growth businesses whose services and products are in demand. And that's what we're trying to do with the Monks portfolio, is build that diversified and eclectic mix of portfolio companies. It's a sensibly stewarded investment trust with an experienced board who have a strong track record of delivering for shareholders. So I can point to low levels or low cost debt at around 2.7% of a blended debt that Monks utilizes, but also a strong record on buybacks over the last couple of years, 380 million or so of buybacks since the start of January 2022, which equates to around about 12% of the issued share capital in the trust. But that's very much in the interest of existing shareholders. So the key or the core attractions of Monks, I think number one is a great way to get broad exposure to some of the world's leading growth companies, wherever they are in the world and whatever sector they operate in. The portfolio is positively aligned with deep structural changes that are taking place in society and the economy today. Some of them I've pointed to earlier, which we think underpin its future growth prospects. And importantly and excitingly, from today, the opportunity set we think is broadening. So we're finding more and more exciting ideas for the portfolio. So it really is an exciting time to be invested within the trust, and it gives us every confidence in its future returns for savers.